Well, we've got a new government, a new Prime Minister, and a new set of policies which the new Prime Minister says are going to bring Australians together and help unions and business drive productivity, lift wages and increase profits. But in this week's Property Insider video, Dr. Andrew Wilson and I share some of our concerns about what rising wages, rising inflation, rising interest rates could eventually do to our property markets. And we remember some times when we've lived through similar circumstances and the terrible results that occurred from those. So if you want to keep up to date with what's happening in our property markets and the economy, please subscribe to this YouTube channel and click the little bell icon so you can be kept up to date each time a new show comes out. Well, the results of the 2022 federal election are in, and Anthony Albanese will be Australia's 31st Prime Minister. In his victory speech, he said he wanted to bring Australians together, and that together we're going to work in the common interest with business and unions driving productivity, lifting wages and profits. He explained he wanted an economy that works for the people, not the other way around. But these are interesting times, challenging times for our economy, so I look forward to this week's Property Insider chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, so we can discuss our economy, the latest unemployment figures, wages growth, and what the Reserve Bank feels is going to happen to interest rates. And we'll also, of course, talk about what the new government may mean for our property markets. Hi, Andrew.
Yes, hello, Michael. It's is it not deja vu all over again with those accepted speeches about bringing everybody together? Let's hope that for once becomes a reality and not just a bit of spin for the victor. That typically we hear a change of government, but there are very challenging times ahead. There are commitments by the new government to particular policy stances, and given that we are in a unique but very concerning inflationary period that we haven't seen for quite some time, it will be quite interesting to see how this now pans out with what looks to be a different policy position from the new government, particularly in relation to wages.
Well, that's going to be very important. Let's first have a talk about what it may mean for property, because it looks like we're going to have a Labor government for a number of terms now, considering the substantial defeat of the Liberal Party. Now, we know the Labor Party's backed down from its previous proposed changes to negative gearing, promising to maintain the existing regimes for negative gearing and capital gains tax if it came into power. And we know it also promised first home buyers an ability to get into the market with its shared equity scheme. It pledged to build 30,000 new social housing and affordable housing properties in the next 5 years. So how do you see things playing out in our property markets under the new government, Andrew?
Well, the big picture is interest rates, is it not? The real question mark is that if we start to pursue policies of artificially increasing wages, then will that not fuel more inflation and therefore activate the Reserve Bank to increase interest rates more to try to slow down that inflation price and wages spiral, which certainly has the potential of developing under those circumstances of pushing wages up from the government's stance. And of course, that would be make properties less affordable and impact confidence as well. So I guess that's the big picture, what these wage-driven policies, the impact they'll have on inflation. Maybe you and I are the only ones that remember the 70s. It is deja vu all over again. We had governments try to control inflation by pushing up wages to cover increased prices. And of course, that ended in the recession of the early 80s. We talk about the Great Recession of the early 90s, but certainly there was a significant downturn following the inflationary outbreak of the 70s in the early 80s, and quite interestingly, that cost the then Liberal government its position. I think,
Andrew, let's discuss that just a little bit further, because the election promise from the Labor Party was to deliver a minimum wage rise to match inflation. Now, while it's still dependent on Fair Work Australia endorsing this, I think the outcome is very likely. But it's also, as you say, going to deliver some challenges. Now, we know a great many Australians actually enjoyed higher wages in the last couple of years, but they were more the skilled workers, and the average Australian, they're still struggling to make ends meet, to the cost of living swamping them. Now, normally labour shortages boost wages, but it didn't seem to happen this time round. But Andrew, what I can see is that if more money is in Australians' pockets, this will mean they'll spend more. It'll grease the wheels of the economy. But many enterprises, they're going to benefit from extra consumer spending, but others, I guess they're just going to raise their prices to be able to pay the extra wages. Isn't this just an inflationary spiral?
Absolutely. And that's the classic outcome, Michael. Once you move inflation, once it starts to move upwards, then we start getting that position where consumers need to cover the extra prices. So therefore they demand higher wages. And those higher wages, of course, come at a cost for employers. Employers have to match those higher wages to maintain their profit margins by increasing their costs, and costs go up. And therefore consumers say, well, I need more wage rises to cover those extra costs. Employers then have to push up prices to cover the extra wage increases, and on we go. And hello, welcome back to the 1970s. And there is really no way to place the inflation genie back into the bottle other than to let it run its course. And unfortunately, that course means to reduce demand. And that's why the Reserve Bank is pushing interest rates up, is to try to cool an economy. But unfortunately, the circumstances are different this time to some degree, is that we have these outside forces that are driving inflation, outside of demand-driven inflation. However, we are seeing signs that local demand is now moving into inflation. That's what's activated that flip-flop from the RBA to increase rates sooner than they'd been predicted. Concerns that it was moving into the general economy, those inflationary expectations. And of course, that will now only increase with higher wages fueling inflation and putting employers under pressure to raise prices. Unfortunately, Michael, we've just got to really wait for it to evolve. And it is, as usual in economics, it's something that is different from previous cycles. So we just can't flip open the economics textbooks and look to answers there or answers what happened in previous cycles. All bets are off. This is a new world of economics. That is the concern, that we have other factors such as the Ukraine war and the potential for another COVID outbreak that might interfere with all those theoretical stances.
Well, I remember the 70s well. I bought my first investment property. I took a 30-year loan, went house with my parents to buy a property at $18,000. And the Labor government came in, the Whitlam government came in, the inflation was rampant. The property increased so much in value and the rents went up so much, I could buy another one a couple of years later. Those inflationary times were very good for people who owned real assets, particularly real estate, but it eventually meant interest rates rising. Interest rates were around 10%. Remember when we were happy if your mortgage was less than 10%, you thought things were good, but inflation was higher than that. So real interest rates were still low. Great time for property until it all came to an end with the recession. Most people don't even remember the recession of the early 80s, but that was the first one I experienced, and I learned, hey, property values don't always go up in a straight line, do they?
No, but I guess in a way we have again some similarities, Michael, because if anything, our housing markets are in a generally stronger position, notwithstanding the potential for higher interest rates, which of course are coming from a very low base, and there are a number of offsets to higher rates in the shorter term, such as still wages growing. We have the buffer, of course, high savings levels. That'll offset higher mortgage costs, and higher mortgage costs only really affect a small proportion of households anyway, with half of all owner-occupiers actually owning their properties outright without even a mortgage. So what do they care about interest rates? They're more worried, I guess, about inflation. And of course, in terms of the actual situation in our housing markets, we still have demand ahead of supply, Michael, and demand will continue to push ahead of supply. We know supply is low. We just have to look at our rental markets, which basically have run out of rental properties. Rents are increasing by more than 10% per annum at the moment in most capital cities. And of course, we have demand drivers coming through. Borders are opened again. Migration is up and running. We have student numbers set to come back into Australia. That's demand for property from both ends of those from open borders or opening borders. And of course, we have a raft of policies designed to encourage first home buyers into the market in high numbers. So that again increases demand for property. With those shortage of rental properties and rents ballooning strongly at the moment, there's a lot of investors that want a piece of that cake as well. So we've seen the doubling in investor numbers over the past year. So plenty of demand, not enough supply will keep upward pressure on prices and rents, in my opinion, in the housing market, but it certainly won't be anything like what we've witnessed over the last couple of years. And of course, it is offset nonetheless by higher interest rates, and that tends to moderate the capacity of prices growth. But make no mistake, Michael, demand remains well and truly ahead of supply in our housing markets. The key question is, of course, our economic performance and how that relates to confidence going forward, because confidence is always the key, particularly in major asset purchases such as housing.
We know the Labor Party lost the last election based on potential changes to negative gearing, capital gains tax and franked dividends, and they said they weren't going to change things. But how long would a promise like that last, Andrew?
Well, certainly, I think that promise is current within this term of government. But given the potential strength of the Labor Party going forward and the weakness of the opposition, I think that they could then perhaps test the waters for the next election by proposing a reintroduction of those particular property tax policies, knowing that they were in a much stronger position to implement that, given the state of the parliament.
Well, I read with interest that Scott Morrison owns his own home and no investment properties, and apparently Anthony Albanese, apart from his own home, does own a number of investment properties. So it'll be interesting to see where the vested interests lie, Andrew.
Yes, and I'm not surprised about that, Michael.
Well, last week, the latest employment figures came out, and while there was a lot of fuss about Australia's unemployment rate now dropping to 3.9%, it was only a couple of decimal points that changed. Despite all this, in fact, employment growth, disappointed, was only up 4,000 in April.
Yeah, you're absolutely 100% right there, Michael. It was a good headline, lowest on record for the monthly series. Was basically the same as the previous month. And I think we've discussed how we felt that perhaps we've actually reached that lowest unemployment benchmark now. And the signs were clearly there again. Unemployment rate was steady, notwithstanding the minutiae of the decimal points. But we did have a very disappointing increase in the number of employed. That was the lowest result we'd had since the recovery from the lockdowns in spring of last year. It was just 4,000 over the month. And the other thing that was interesting was that the participation rate actually fell. So if we had have had the same participation rate that we did over the previous month, and if we had have allocated those to being unemployed, we would have actually had a higher unemployment rate with the same participation rate. So I think overall it was another steady result with signs there that we've peaked in terms of our labour market performance. However, of course, this will be revealed in coming months. If this is where we've peaked, Michael, this is a very good base, of course, and a good result. But let's understand that our workforce has grown certainly a lot less than over the last two COVID-affected years compared to the previous pre-COVID years where we had migration fueling the workforce. So we've got that happening again, which will create more supply for employers. So that's another offset to the full employment environment that we have now, is that we do need to absorb hundreds of thousands of migrants as our borders are opened up. We also had the wages data released last week, Michael,
yes,
which is a little sobering.
Well, it was clearly disappointing, wasn't it? It reported another very modest result. In fact, a fall in real wages when you take into account the cost of living.
Yes, it was a 0.7% increase over the quarter, which was exactly the same as was resulted over the December quarter. The Reserve Bank's been espousing its inside information in regard to wages growth. It was confident that wages were growing from that inside information. That position certainly wasn't supported by the wage index data, which would have been a clear disappointment to the RBA's expectations. As you mentioned, Michael, the real concern was that we had a record fall in real wage declines. We certainly had a sobering result in terms of real wages going backwards. In other words, inflation is moving rapidly ahead of wages growth. Of course, that's a reason for the Labor government's policy to try to address that. Well, good luck. It was a disappointing result in relation to what the Reserve Bank has been indicating it felt would be a stronger result going forward. I mean, its expectation is for wages growth to peak at 3.75%. I'm not sure we're going to see that, but however, given these sort of artificial positions on wage fixing now with the new government, we may sort of achieve that. But we've just got to hope that the cost there isn't higher inflation and higher interest rates.
Well, recently we got some insight into what the Reserve Bank was thinking with the RBA minutes,
Yes.
and they were talking about maybe having even increased the interest rates higher in May than they did, which makes me think that we've got quite a few interest rate rises ahead anyway, despite all the new things happening with wage increases, if that's what's going to happen.
Yes, those minutes, of course, were released at the beginning of the month, Michael. And as we've just discussed, there's been some important data out since then, which I think, if anything, would have the Reserve Bank rethinking to some degree its strategy going forward. I think it's predicting an interest rates by 1.75% by the end of this year. I'm not sure that that's feasible given a strong but steady labour market and disappointing wages. As I said, for that particular strategy, I'm sure the Reserve Bank would be looking for higher wages growth to come out in the March quarter GDP numbers to be released shortly. But as I said, I think that perhaps they may be rethinking their strategy, would wait for the next wages data to come out, because higher interest rates, of course, at one level can be inflationary as well. It's a difficult position for the RBA. Nobody's saying it's easy. It is a very, very fine balancing act. There are a lot of forces outside its control. And if the central banks get it wrong in terms of interest rate policy, it can result sooner rather than later in a significant economic downturn. And that's really the lessons that we have from the past, that you have to be very careful with an inflation outbreak. And sometimes, unfortunately, Michael, the only way really to quell inflation is to produce that downturn.
Unfortunately, that's true. Now, I was interested that over the weekend, people held auctions, not as many as normal, but the Melbourne and Sydney property markets still delivered quite a lot of auctions. And I guess, not surprisingly, generally lower results, auction clearance results over the weekend.
Yeah, generally lower, but I think that it still reflects the current state of the market. I think it's interesting, Michael, that if we look back to last election day and look at the auction numbers then, our auction numbers were actually substantially higher this election day. And I think what that reflects is the part of the cycle that we're in. Of course, we forget that 3 years ago, we were in the midst of all the doom and gloomers predicting catastrophic house price crashes. Of course, the reality is that house prices in Sydney have risen by 55% since the last election, and in Melbourne, they're up by 40%. So those doom and gloomers got it wrong big time. But it was impacting the housing markets at that time, Michael. There was a lot of concern. We had just come out of the Banking Royal Commission. As I said, all those predictions of house price declines. And we also had a Labor Party at that time that was proposing, as you mentioned, the changes to negative gearing tax relief for investors. So even though the results were reasonably balanced, just maybe still a seller's market, but reasonably balanced, they're not too far off, Michael, from where we've been over the last month or two, those auction results, off low numbers, of course. But we have had a lot of hits to confidence recently. And I think that, moving into the winter period, we will see a lot of buyers and sellers take a wait and see approach to the market. We've got a couple of weeks left before the winter shutdown is upon us, which usually occurs after the Queen's birthday, long weekend holiday towards the end of June. The market starts to subside over July. So it is a period of quieter market activity anyway, Michael. And of course, it's going to be very interesting on the policy front in between now and the spring selling season, not just the government policies, but also the Reserve Bank policies, which will be revealing.
Okay, we'll look forward to having a chat again next week.
Thank you, Michael.